One of my viewers, RadioVox, asked me a question yesterday about mining industry hedges. He said that he read that only 2% or 40 tons of annual mine supply is now hedged, and he asked if I thought the reduction in hedging had any implications. I wasn't sure if he meant gold or silver, and equally unsure of whether or not what he read was accurate. Out of curiosity, I updated my Comex commitment of traders data to see if there were any interesting trends in the data. I'm sorry to say that I don't think that the report that RadioVox read is accurate. However, I am very happy to say that there is a very interesting trend in the COT data. One that explains an inconsistency in the way that gold and silver inventories are moving in the warehouses. If you recall, I put out a video a few days ago that discussed how very large holders of gold and silver can use their metal to generate an interest rate for themselves. I went to great lengths to explain how the mechanism works. If you haven't seen the video, please click on the link that I have placed on this slide. It will give you the background information that you need to understand much of what I have to say in this video. Here's a very brief summary of what I pointed out in that video. If we take a look at the rate curve for gold and silver as constructed via futures pricing and compare it against the US Treasury market rates, we can see two very interesting things. The first is that there is no incentive for the owners of investment gold and silver to mobilize their holdings on the exchanges to bid for the debt of the US. In other words, there is no incentive to lend the gold and silver, and so one could expect that the owners of gold and silver will remove their metal from the registered category on the Comex and possibly even withdraw it from the warehouses entirely. The only possible reason for the metal to be left in the registered category would be to take advantage of the current backwardation in the near-term futures contracts. The owners of the metal, provided they had faith that their metal would be returned to them, could potentially sell their metal at spot, buy a near-term future, collect an immediate profit, and simply wait for the return of their metal. Backwardation is a condition that happens from time to time in some commodities that are consumed, and it's a sign of a shortage of that commodity that needs to be rectified. For a monetary metal, though, especially gold, it is a sign of loss of faith in the paper market. After all, if metals owners trusted the integrity of the futures market and had absolute confidence that their metal would be returned to them, then the risk-free return offered would be quickly snatched up, and the condition of backwardation would resolve itself. Next, I showed how the actual inventories of metals on the Comex exchange have changed over time. I showed the trend in gold inventory in the Comex warehouses and pointed out that ever since about 2005, gold has been moved out of the registered category on the Comex. In other words, for quite some time, less and less gold has been lent to the market. This was an obvious consequence of treasury rates just not being sufficient enough to entice the owners of gold to lend it out. I also showed that for the past few years, gold has even been disappearing out of the eligible category. In other words, gold is moving out of the Comex warehouses. It is clearly expressing its opinion that the Comex warehouse system is just not the best place for it to be. One would view this movement in gold as consistent with the fact that gold is simply losing interest in bidding for paper. So it would be logical to expect silver to exhibit the same trend. But if we take a look at silver inventories on the Comex, we see something completely different. We see that for the past few years, silver inventories in the Comex warehouses have been building, and building by quite a lot. The inventory is showing up both in the eligible as well as in the registered categories. And one has to ask the question, why? Why is so much silver showing up at the Comex? Why would silver trust the market when gold does not? It's a question that I've been asking myself for days, and it's a question that's been bothering me quite a bit. But thanks to RadioVox's question, I think I now know the answer. Here's a graph of commitment of traders data going back to the year 2004 for gold. In the top graph, I show the number of ounces of gold shorted by the commercial interests, and the number of ounces of gold represented by long futures owned by the speculators. The bottom graph shows the number of ounces the commercial interests hold long against the number of ounces shorted by the speculators. Before I go on, I should probably tell you why I plot the data in this manner. The reason is that the commercials on the short side are the mining companies. They are the ones who are selling forward their production so that they can lock in a profitable price. One can view this as a pricing insurance operation on the part of the mining companies. Traditionally, the insurance is provided by the speculators who take the long side of the trade. The speculators are the ones who are taking the price risk. You can see when the two sets of data are plotted against one another that there's a very close correlation in their movements. In the bottom, I am graphing the activities of the commercial longs. In gold, the longs consist primarily of those who want to lend to their gold to obtain interest. They will buy futures contracts so that they can get their gold back at a later time. In addition to those who are lending their metal, the commercial long category also consists of those who simply buy the long futures for cash in order to take delivery of the metal in the future. This is done without mobilizing existing metal. The speculators also make the market for the commercial longs. In the aggregate, all of the futures positions net out to zero, but plotting them in this way gives you a good idea of which parties are doing what. There are a couple of things that are very interesting about these graphs that I'd like to point out to you. The first is a slow divergence in the top graph that has taken place since 2005. While the activities of the spec longs have matched the hedging operations of the miners in the short-term movements, we can see a growing gap between the two curves. This means that more of the future mine production is being secured with cash as opposed to being secured via gold loans. It is completely consistent with the decreasing trend in the registered gold inventories starting in the year 2005. There has been a slow and quiet cornering of future mine supply by the commercial interests who want to own the gold itself and not just speculate on the price movements of gold. The other interesting thing that I wanted to point out in this graph is the hedging activity of the miners since the gold price peaked in 2011. Notice that the mines have been selling less production forward as the price of gold has dropped. This is a sign that the mining industry executives are being good stewards of their investors' wealth. As some of their deposits have become uneconomic to mine, they are committing to fewer and fewer new projects. As they continue their production to honor the old contracts, they are not replacing their old short positions with new ones. The gold mining executives will have the option to curtail production if they have to, rather than depleting their investors' wealth in an irresponsible manner. Now let's take a look at the commitment of traders data for silver and see what it has to tell us. Here's the COT data for silver. There are some similarities between the silver futures and the gold futures, but the differences are very interesting. First, let's talk about the key similarity. We can see a growing gap between the commercial shorts at the top representing forward mine sales and the speculative longs. So just like gold, more and more mine production is being funded with new cash purchases of silver futures as opposed to metals lending operations. The commercial interests who would like to take delivery of the silver at some point are and have been increasing their purchases of futures. But notice what the miners are doing in the top graph. While the gold miners have been curtailing their forward sales since 2011 as the price of gold dropped, the silver producers have been increasing their forward sales. The mines have a production commitment that is quite a bit higher now at $16 per ounce than they did in early 2011 when the price was 2 to 3 times higher. If one agrees with cash cost numbers that are typically thrown around, such as $20 per ounce, then one would have to believe that the producers are acting completely irresponsibly and irrationally. The commercial longs, on the other hand, have significantly increased their commitments for future silver deliveries as the price has become more and more favorable for them. So it appears that the longs, at least, are acting quite rationally. The behavior of the commercial interests, both long and short, are completely consistent with the inventory build that we've been seeing in Comex warehouses. The producers have ramped up production, and the metal being produced is going to the warehouses and not coming back out, at least not for now. The only loose ends that need to be tied up are, 1. Why are the producers committing more and more production despite an unfavorable price trend? And 2. Why is silver staying in the warehouses whereas gold is disappearing? We can answer the first question about why the silver producers are committing to more silver production despite an unfavorable price trend by considering that most silver production is as a byproduct of the production of other minerals. There are very few silver producers that operate solely for the production of silver alone. Much of the silver produced comes as a byproduct of the production of copper, lead, and zinc. We have production statistics for each of these minerals compiled and reported by the U.S. Geologic Survey. Notice that the production of silver in 2013 was 9% higher than it was in 2011, despite the declining price trend that would tend to make silver production less attractive. Well, notice also that copper production had increased 11% over the same period of time, lead production had increased by 15%, and zinc production had increased by 9%. Because silver is a byproduct, it is not at all unreasonable for the growth rate in silver production to track the increase in copper, lead, and zinc, despite what the price trend of silver was doing. So the increased silver shorts put on by the producers could simply be in tandem with the planned production of the other metals. And this takes me back to the video I did a while ago called Hubbert Linearization of Gold and Silver. If you haven't seen that video, you can check it out by clicking on the link in the upper right-hand corner of this graph. Recall that for a non-renewable resource, the production rate of a particular resource can be correlated against cumulative historic production. Plotting the ratio of current production to cumulative historic production against cumulative historic production itself tends to produce a straight line that can be used to determine a logistic curve of future production. As Marion Hubbert demonstrated, if a resource is depleting, the slope of the line will trend downward. I showed in my video that silver's curve does not slope downward, but slopes upward instead, indicating that it has not yet hit the point where production rates are in any danger of slowing down. Quite the contrary. Which can be seen when the logistic regression is shown as a plot of production rate versus time, as I have done here. We see production rate increasing exponentially. In fact, the rate of growth in production is increasing with each and every passing year. In other words, the curve of production versus time is not just exponential, it's super exponential. Now, I'm not saying that this trend will continue forever. Obviously it can't. But if it does persist in the near-term future, there is a danger that production will overwhelm industrial demand. For most commodities, production will not exceed demand simply because price would collapse if it did. The production of silver, to a certain extent, can be curtailed if it exceeds demand, but only by closing the primary silver mines. The rest of the production will still continue if the miners are still producing copper, zinc, and lead. Now let's take a look at mine supply and compare it to industrial demand. Here is some familiar data from the Silver Institute. We can see that 9% increase in mine supply from 2011 to 2013. We can also see a 6% decline in industrial demand for silver. The difference between production and industrial consumption had to go somewhere. Some of it went to increased sales of coins worldwide. Quite a bit of it, though, has shown up as good delivery bars on the Comex. The reason why it hasn't been withdrawn, as gold has, probably has to do with the fact that the owners of the stock intend to consume it at some point in the future, as opposed to hoarding it as a wealth asset.